In the world of business, nothing sounds sweeter than the word revenue. It's the lifeblood of any enterprise, the measure of success, and the fuel for growth. But simply getting an order or receiving a promise of payment isn't enough to say you've made money in the eyes of the accounting world. Enter revenue recognition, a crucial accounting principle that dictates precisely when a business can officially record income from sales of goods or services. It's not just an accounting nuance, it's a legal and ethical cornerstone that ensures financial statements accurately reflect a company's performance, preventing misleading reports and fostering investor trust. Imagine a company that reports huge sales figures just by signing contracts, even if they haven't delivered anything or received payment. This could artificially inflate their perceived profitability, deceiving investors and creditors. Revenue recognition rules prevent such manipulation, providing a consistent and transparent framework for all businesses. The timing of revenue recognition directly impacts a company's reported profit, its tax obligations, and its perceived financial health. Get it wrong, and you risk everything from regulatory penalties to investor backlash. For decades, businesses generally followed various principles for revenue recognition. However, the complexity of modern transactions led to inconsistencies. This prompted the Financial Accounting Standards Board and the International Accounting Standards Board to collaborate, creating a unified, comprehensive standard.
This new standard is known as ASC 606 in the U.S., Accounting Standards Codification Topic 606, Revenue from Contracts with Customers, and IFRS 15 internationally. It's a game changer, replacing a patchwork of industry-specific rules with a single, principles-based framework applicable to nearly all industries. At the heart of the new standard is a robust five-step model that companies must follow to determine when and how much revenue to recognize. Let's break down each step. The very first step is to identify if a valid contract exists between the business and its customer. A contract doesn't always have to be a formal written document. It can be oral or even implied by customary business practices. However, it must meet specific criteria. The parties must have approved the contract and be committed to their obligations. Each party's rights regarding the goods or services must be identifiable. Payment terms must be identifiable. The contract must have commercial substance, i.e., it changes the risk, timing, or amount of future cash flows. It must be probable that the entity will collect the consideration to which it's entitled. If these conditions aren't met, a company cannot recognize revenue from that agreement. A single contract can often involve multiple promises to the customer. For instance, selling a new car might include the car itself, a warranty, and free maintenance for a year. Each distinct promise to transfer a good or service to the customer is called a performance obligation. A good or service is distinct if the customer can benefit from it on its own or together with other readily available resources, and the promise to transfer it is separately identifiable from other promises in the contract. Breaking down a contract into these distinct obligations is crucial because revenue will be recognized for each obligation separately. Step 3 involves determining the total amount of consideration, money or other value, the business expects to receive in exchange for fulfilling its performance obligations. This isn't always as simple as the list price. The transaction price can be variable, meaning it might depend on factors like discounts. A customer might receive a discount for early payment or volume purchases, rebates, cashback offers or future price reductions, refunds, estimates for future returns, performance bonuses, additional payments tied to meeting certain milestones, penalties, amounts deducted if specific conditions are not met. Companies must estimate these variable amounts, factoring in potential outcomes and probability to arrive at the most likely transaction price.
Once the distinct performance obligations and the total transaction price are identified, the next step is to distribute that total price among the individual obligations. This is typically done based on the standalone selling price of each distinct good or service. For example, if you sell a software package, installation, and a year of support all bundled together for a single price, you need to determine what each component would sell for individually. This allows you to allocate a portion of the bundled price to the software, another to installation, and another to support. If standalone prices aren't available, companies must use observable inputs to estimate them. This step is vital because it ensures that revenue is recognized appropriately for each component of the contract as it is fulfilled. The fifth step is the ultimate when. Revenue is recognized when or as a company satisfies a performance obligation by transferring a promised good or service to a customer. This transfer occurs when the customer obtains control of the good or service. Control generally implies the customer has the ability to direct the use of the asset, the customer can obtain substantially all of the remaining benefits from the asset. Performance obligations can be satisfied over time if the customer simultaneously receives and consumes the benefits as the entity performs, example, a subscription service, continuous maintenance, or if the entity creates an asset that the customer controls as it is created, example, custom-built software for a client. Revenue is recognized progressively. Or at a point in time, if control of the good or service transfers at a specific moment, example, a customer walks out of a store with a product, or a large piece of equipment is delivered and accepted. Revenue is recognized once the transfer of control has occurred. This step is the culmination of the entire model, allowing businesses to finally say, yes, we've earned this money and can report it as revenue. The implementation of ASC 606 and IFRS 15 has brought unprecedented consistency and comparability to financial reporting globally. It has improved transparency for investors, allowing them to better understand how companies earn their money. For businesses, it required significant changes to their accounting systems, processes, and internal controls, but the benefits are clear. More accurate financial statements, better internal decision-making, and enhanced credibility with stakeholders. Revenue recognition isn't just an arcane accounting rule, it's the gatekeeper of financial integrity. It ensures that when a company says it has made money, it's done so by delivering value and fulfilling its promises, building a foundation of trust that is essential for a healthy economy.